your screens. The first rate's coming up, and we'll then sort of focus on individual stocks because there's earnings reactions and all those tax issues, etc. So 25,000 plus on the Nifty is what you have, and we are at a fresh all-time high, of course, and a important psychological level has been crossed for the market. So that is the big number which is flashing on the screen, and so many milestones over the last 2 years. I mean, milestone after milestone, and you know, it's coming in fast as we've kind of highlighted for a while now. So, you know, last year we left off at I think what, about 22,000, and this year we're at 25,000. So, and this is just half a year done. That's the ferocity of the move that we've seen. The best performing market in 2024, one of the best performing markets in 2023, the best performing market in 2022. I could go on and on, but it's a big one this morning. The Sensex is up about 81,940. You got the Bank Nifty, which is starting about 0.4% higher as well. But we've got lots of stocks to track, so let's get to it.
You know, when the Nifty hit 24,000, it was the 27th of June, you know, just a month back. Nigel and I missed it because instead of watching the shares, we were watching the shares in the jungles. But that's on a lighter note. Here we are, both of us here this morning as 25,000, another milestone conquered by the bulls as they continue to charge down the streets. A big morning today coming through. Okay, stocks. Maruti is still continuing its great form from yesterday after the good numbers coming through. A lot of metal names are looking good. Hindalco, JSW Steel, 2.5% higher. Coal India's numbers are being very well received by the market. There's also ONGC. So basically, a lot of commodities in the mix looking good this morning. Tata Motors will be reporting numbers today. That stocks are very well poised in anticipation of a decent show. Bajaj Auto came out with the monthly sales numbers. The numbers look good. Stocks up about 1.5%. Tata Steel is also reacting positively. Despite that hangover of a potential tax demand, a large one, 17,000 crores. For now, the stock is sticking to numbers and reacting about 1% on the upside. The Bank Nifty is not playing too much of a spoil sport today. That's good news for the bulls. So a lot of names like SBI, IndusInd Bank on the upside as we start off with. Let's look at the downside. Now, even on Infosys, the reaction is about 1% lower. Let's see how this tax demand plays out. That stock's down, but it hasn't taken down the rest of the pack with it. Infosys is the only one that's negative. M&M is still looking at profit taking after the numbers. And Hero Moto is the other one. That's down about 1.5%. But a good morning, 25,040 on the screen.
Well, it can't be a subdued celebration. 25,000, guys. You know, that's something that we have been looking forward to. And 25,000 it is. We talk about the Nifty moving to 1 lakh odd. At least we are happy to be here at around 25,000 on the Nifty. So a fourth of that journey is what's been completed in terms of the Nifty. And big moves today. You know, Maruti, that's driving away up 3.5%. Tata Steel, well, that's opened up in the green, but actually it's underperforming the metal pack. You have Vedanta that's up, Hindustan Copper that's corrected from more than 400 rupees to around 310 rupees. People stopped talking about that, actually, the entire big copper rally that we saw. Stock is corrected 25% from the recent peak, but today as well, that's participating in the up move. And since crude prices popped up, you have ONGC as well as Oil India. Both of them are doing very well in trade. So metals as well as oil and gas stocks, well, they are doing well in trade. We had some news flow coming in on Amara Raja in pre-open, I think. So that stock, in fact, is up close to around 2%. Vedanta is moving ahead with that demerger plan. The street likes it, so that stock is doing quite well. Birlasoft yesterday was under pressure. Today as well is down close to 100%. The numbers very disappointing. We get to the chat with the management in a bit. And Siemens as well. Siemens down close to around 2% odd. But 25,000, guys, we're waiting for this mark. And here it is. Thursday morning, weekly expiry day on the Nifty. The Nifty says, let's party. We like what the Fed said.
You know, I was just looking at the past numbers, 2000 and the horrible COVID year, right? I mean, we left off at 14,000. So, you know, you just sort of, you can reminisce and you can look at where you were and what prices were. And but that's what markets have done. They've belied all, or rather beaten all expectations, even the most optimistic expectations. They continue to move higher. And it's not just, you should not look at this in isolation. The fact is that, you know, at least for the last 3 years now, and maybe 2024 as well, the way it's panning out so far, we've kind of outperformed every other market. So that is quite something, I mean, which stands out. Mangalam is going to also just join us in a bit to run us through some more. Let's get Krishna Sangvi in, CIO Equities at Mahindra Life Investment Management. Krishna, good to have you with us here. Thanks very much. 100-point gain on the Nifty, past 25,000. First thoughts? Krishna, you're on mute. You'll have to unmute yourself, please.
Sorry, yeah. Thanks for having us. Yeah, I think 25,000 is a good milestone. Broadly, in line with everything, economy stroke, market momentum in place. Some of these milestones are good to have, and hopefully we'll have, many more such. But I think the broad connect is simple. Economy is doing reasonably okay. Long-term track in place, and yeah, currently the market mood is slightly more driven by liquidity and sentiments, and that's something we need to be slightly more watchful in terms of the sentiment and the momentum part of it.
Okay, by the way, I just want to point out that the move on Maruti is absolutely breathtaking. It was up about 4% in the dying moments of trade yesterday, and it's putting on another 3.5–4% on that performance that's come through. Strong margin improvement and beating estimates. It's really the star even today. There are other movers and shakers. Look at 361 WAM. Yesterday we were talking about SEBI looking at pulling up the F&O segment and putting more cups. Look at the broker stocks go. That stock's up about 7–8% on the higher side. So lots of movers on the mid-cap screen.
I think that's earnings came, and so that's more wealth management focused. And Novama, 361, and those of the wealth management stocks have done very, very well. But Mangalam is here to map the journey to 25,000. Mangalam, take it away.
What a moment this is, right? Nifty at 25,000, and if you just take a look at Nifty's journey itself, Prashant, for an index that started way back in 1996. April 1, 1996 is where, the Nifty started.
Mangalam,
I think, you'll have to...
Sorry. Mangalam is here. I can assure you. You heard him. You'll see him as well in just a bit from now. Krishna, just to sort of come back to you, Surabhi was talking about the wealth management names. So you've got to look at if the... it's logical. If India is going to get richer, market caps are going to go higher. Wealth management and specialized services on the financial side. I mean, that's going to be needed. I just wanted your thoughts on this aspect. Could this be a secular story, notwithstanding intermittent falls, etc., which are to be expected in the market? These are at the end of the day market-dependent businesses, but from a longer view, how are they looking, even from a valuation point of view?
Yeah. No, sure. I think from an economy side, clearly India is one of the fastest growing nominal GDP economy. Nominal GDP creates income, and people have income to save because once the consumption needs are met. So I think that macro story of wealth creation is in place through the capital marketplace. Challenge can be possibly valuation, but honestly, some of these valuation concerns can be diluted only by taking a longer term view, and that's where some things may be useful to say, okay, the macro story is in place and some of these businesses will benefit. But yeah, currently I think broadly the way broad market itself is slightly richly valued. I think some of these companies by default run a risk of earnings in case the market does correct, and because this business is not only the multiples but even the earnings are linked to markets.
Okay, got that, Krishna. Coming back to you, let's map those milestones with Mangalam. He's here. Mangalam.
Well, it's one of those where were you when the Nifty hit a certain level sort of moments, right? And 25,000, no mean feat. And it's poetic that it happens in the 25th year of CNBC-TV18 itself. For an index that started on April 1, 1996 with a base of 1,000, had moved to 5,000 in 2007, then took 10 years to move to 10,000. Remember, clearly there was confetti in the CNBC-TV18 office when the Nifty hit that 10,000 mark. Thereafter, 15, 20 and 25,000 itself. So while this journey has been long, the important part is that over the last many years since inception, the Nifty has compounded at 12.1%. What does this mean? Every 6 years, this index has doubled. So that's one of the bigger stories. The other story is that while Nifty itself has compounded at 12% since inception, in the last 23 years, Nifty earnings also has compounded at 12% itself. So the Nifty journey is tracking the EPS journey. And at 25,000, the index trades at around 22 times FY25 price to earnings. So that's something we'll have to watch out for too. The last time it hit a big milestone, 20,000, was in September 2023. And since then, it's been a public sector, realty, oil and gas and auto sort of rally, all these indices having done extremely well. The ones which have actually underperformed are the ones like IT, FMCG and, Nifty Bank. Even if you account for the recent rally that we've seen in all of if you look at the IT index, it's up around 26%, FMCG 19%, Nifty Bank up 13%, much lower than what the others have done as well. So let's take a look at the broader markets. Those two have done extremely well. Small cap index up 50% in the last 1 year, mid cap index up 42%. The SME IPO index is up 164%, and this is at an index level. A lot of individual stocks have been 5-10 baggers as well. In individual stocks on the Nifty, like I said, it's been about autos and the public sector enterprises. So you have Bajaj Auto doubling in the last 12 months or so. BPCL up 93%, Coal India, M&M, ONGC, all of them gaining anywhere between 80 to 90%. And then you have a bunch of other underperformers as well. Bajaj Finance down 8%, Asian Paints down 6%. HDFC Bank, the biggest weight, is actually down about 0.5% in the last 12 months or so. We're talking about the broader markets. Oil India up 200%, NBCC up 200%, Trent, Oracle, Amara Raja, all of them up around 150 to 175% as well. Here too, we have a couple of underperformers, so that's something that we'll keep an eye out on as those come up for you on your screen. A bunch of underperformers in the broader markets would include names like Z, Dalmia Bharat, Naveen Fluorine, IDFC First, and PVR Inox. Now that we've hit 25,000, the big question, where do we go from here? And what are the triggers to track? The first one, will FIs return to buy in the cash markets? Secondly, with the outperformance that we've seen in the mid caps, will large caps now start to outperform mid caps? There is increasing retail participation and domestic SIPs. Will that continue? Irrespective of what, the regulators say, hefty valuations in the broader markets. So what do we do about that? And finally, the impact of geopolitics and global developments on our markets. 25,000 is here, a lot of triggers ahead.
Absolutely, Mangalam. Great perspectives there, and great to map the journey as well. That really helps, that 12% compounding, both earnings and the market. They've kept pace, which is why a lot of people argue that there's no reason to start getting stressed or worried because earnings are fueling this rally. Let's go back to Krishna. Krishna, what's your sense? There's been leadership change. This rally has had very different leaders, right? The erstwhile stars, Bajaj Finance, HDFC Bank, or even leave some of the FMCG boys. They have not been the poster boys of this rally. What do you expect from here on? 25,000 onwards, say the next 5,000 point journey, who will be the stars?
Yeah, sure. So if I had to add, one more angle to this long-term compound.
Okay, by the way, Krishna, just hang on for a second because we have a very special guest who's going to be joining in. Great day for him to be coming in here as well. That is Mr. Anish Shah, Dr. Anish Shah of Mahindra and Mahindra. He is our special guest. He's, I think, coming up to the studios in the next couple of minutes. And so much to talk about, right? All the group companies at Mahindra and Mahindra. M&M doing exceedingly well. The auto segment itself and auto tractors firing on all cylinders. It's Tech Mahindra, that story to talk about. And of course, just the animal spirits within India Inc. as the market is celebrating GDP growth, corporate growth, and so much more. So that's Swati accompanying Mr. Shah, and they will be with us shortly.
No, absolutely. Krishna, do you own Mahindra, by the way, in the portfolio?
Well, we are Mahindra Manulab, so even as an organization, part of the
anything.
Good timing then.
Anything you'd like us to ask him for you?
No, I would like to hear, more like what you're asking. No, I think let's look at that macro picture of economy, earnings, and one variable I'd like to add is even the Indian economy has broadly compounded as 12% nominal over the entire this similar journey right from the time Nifty was, let's say, 1,000 odd. So that biggest connect to economy and markets is what we just simply have to be aware. And coming to those questions about some specific stocks which may or may not have done well in this journey, I think if you look at a longer picture of this 10, 15, 20 years, one macro theme is that as long as economy keeps on doing well, each of these sectors, each of these stocks, have their own chance to participate in the profit pool accretion in the economy, because if you look at earnings profile, I think not every year every sector grows similarly, right? There is this cross current between sectors. Some sectors benefit, some are leads, some are lags. So to that extent, when we look at some of these companies or sectors which may not have done well, I think the same picture changes. Instead of September 23, and we look at maybe September 21 or maybe September 19, the numbers change. Which also brings to the picture that currently what's happening in the market really is that while the valuations are clearly favoring large caps, I think the flows and maybe the momentums are far more in favor of small caps, mid caps, maybe, or maybe micro caps. I think that's a challenge right now in markets. Economy, as long as we do well, I think one should right now favor large caps as a better outperformance category, especially when it integrates the valuation. But yeah, let's not forget, in a macro journey of last 20 years, too many small caps would have become mid caps. and some of those mid caps would have become large caps also. So that's, how these individual companies grow and maybe, grow to higher levels on market caps and maybe wealth creation.
Krishna, our next two conversations are actually going to be, on the auto sector. So let's get your sense in as well. Look at the way the market's rewarding Maruti, for instance, because those numbers were really better than expectations. But there is a school of thought that overall sales are slowing down after the post-COVID high that we had, the big numbers that we had in FY23. 24 has been a little more muted. What's your sense when you're looking at auto, and how would you play it? The stocks have done very well. The question is whether the growth will continue.
Yes, sure. I think growth continues. Maybe the only challenge can be for the market can be the growth rate. So if we are used to a very strong growth rate in FY24, maybe we're talking about something like a single digit, maybe somewhere around 4 to 7%, depending on what agencies would have reported. And maybe individual companies can grow slightly more based on their own volume growth. Maybe there's some companies had a supply constraint last year. So if those supplies are falling in place, they will grow much faster. But as a broad space, I think passenger vehicles should be more in that maybe 5-7% growth, and similarly maybe two-wheelers and CVs too. So growth can be moderated, but yeah, it's still a growth.
Okay. All right. That's the auto space. I think in the next couple of minutes, we'll be touching base with the management of Bajaj Auto as well. And we'll get a sort of, update on the numbers. By the way, the monthly sales numbers for Bajaj Auto have been looking quite good, about 11% up overall, and the domestic sales numbers are up almost 18%. So that growth is continuing, and even exports have shown a bit of an increase. I think just a 2% increase, not too much, but those numbers have been looking very, very well. So, okay. Do we have the management of Bajaj Auto with us? Okay, I think we have them. Krishna, thank you very much. Good chatting with you on the markets. The journey continues 25,000 and onwards. You have a good day. But as promised, let's take that conversation forward with the management of Bajaj Auto. We have Mr. Rakesh Sharma with us. Mr. Sharma, thanks for joining in, and congratulations. Looks like another good month, because on the domestic front, you're firing away. I think the growth is almost 18%. So let's start with the domestic business. I know so much is happening with the new CNG bike as well. How does the second half now look? Because now we'll start getting into the festive season.
Good morning. Yes, the growth numbers look very good, but they don't actually reveal the full story. July is, in any case, a very small month. There is not many degrees of freedom there because of the onset of monsoons in so many parts of the country, and people are also waiting for the festive to kick in, which starts by August and peaks, let's say, in October. But what these numbers don't reveal is the performance of the growth platforms, which we started to launch into the market in June onwards. And Freedom, the CNG bike, has not really kicked in as yet, because the deliveries have just started to happen in the last week. But some of the other things, particularly, our 250cc plus portfolio, Triumph had a really breakthrough month. As you know, it was sort of at 2,000 levels for a few months. Now it is stepped up to above 3,500. And our new launch, the NS400Z of Pulsar, that clocked almost 2,000 units. And if I add that up with our Pulsar 250s and the other 250 to 500 cc's in our portfolio, we are pushing 10,000 units in the month of July. And so that was very good. The other growth platform, of course, is the new launch in Chetak, which was, the 1 lakh, sub 1 lakh pricing new model, which has been received outstandingly well. And we are now jumped presence from about 250 odd stores to almost 2,000 stores across the country, which has increased the market share for Chetak by, a very handsome 6 percentage points. And, bookings have crossed 20,000 units. And the third one I must mention is the electric three-wheeler, which again, thanks to the widening of the network, has had an outstanding month, touching almost 4,500 unit sale, and grabbing 5 percentage points of market share as per Vahan registrations in the month of July. So the overall numbers, we are happy with them. But really, the new growth platforms kicking in so early gives us another good couple of months to ensure the channel is well serviced, consumer engagement is well on its way for October.
Sure, sure. Just a word, I mean, so volume growth is absolutely kicking in. What about realizations and pricing? What do you forecast in the coming months as we get into that peak demand season? Are you looking at price hikes? And if so, across what part of the portfolio?
Well, we had taken a small price hike in 1st of July just to, it was under just about 1%, just to ensure we are in step or slightly ahead of the cost increase curve. Right now, the ups and downs on the commodity front are sort of balancing themselves out. And we are tracking both the cost increases as well as moves by competition. If it is required, we will go in for a price increase. But right now, we are in an equilibrium situation.
Okay, all right. Hi, Mr. Sharma. Good morning and always good to see you in. Just to reconfirm, Triumph did sales of 3,500 per month, if I got that number correct?
Yes, in fact, it was over 3,500 in India. That's right. Triumph.
Expecting this sort of a momentum to continue as well?
I hope so. We had put in some, an extra effort on the sales side, and sometimes, you need to just turbocharge this, and that has really worked. And we would be expecting to continue it in the same vicinity in the coming months.
Let's turn our attention a little bit to the exports then, and particularly Nigeria. As you were telling us, Nigeria got hit hard. It used to do, I think, 50,000 units, and it came down to, I think, 15,000 odd. For the past month, how was it? And do you expect exports to gradually improve from here on?
Yes, actually, that is exactly what I've been saying, that exports is not going to be a sharp increase because it's weighed down by Africa, most of the countries in Africa. I mean, to give you an idea about the slow climb back which is there, Nigeria, our retails have gone from 15,000 to 16,000, and the numbers which I got just this morning about July is 17,000. So you can see that it is agonizing slow, but at least the nose is pointing in the right direction. Whereas the other regions like Latin America, ASEAN are showing handsome growth. But when we combine Africa with all the others, then the overall growth which we see is going to be steady, but in small steps.
Okay, all right, Mr. Sharma, we wish you all the best of luck. Thank you very much for joining us. It's always a pleasure having you with us here on CNBC TV18, and look forward to speaking with you again as sort of you continue to repair some of the sales on the export side, etc. I just want to take a quick look at the market as well. We're past 25,000, comfortably holding those levels, and we're about 100 points higher. So this is a very good-looking screen. And large caps, of course, are doing what they are. But as I've said so many times, it's the broader market which is vibrant and how. Long list right out of the gates, long list of big volume-led gains across the board. And that is where that's why portfolios are going to sort of feel good about themselves. Greenply, we had the management with us in the morning at 9. Stocks up another 8%. It was up 10% after the results yesterday, another 8% this morning. You got Aster DM, which reported numbers. That one hospital company, 4% higher right now. IIFL, of course, I mean, stocks up 4. It's corrected quite a bit. Markets, of course, have been waiting for a final kind of go ahead, all clear from the RBI with regards to their restrictions which were imposed on the gold loan side and not securities, but IIFL Limited, the NBFC. So that's up about 4-5% as well. So that's essentially the picture, but so much more, which I will get to in just a bit from now. But right now, we're going to focus on one of the largest conglomerates in the country, Mahindra and Mahindra. And we have with us a very special guest who's with us in the studios, Anish Shah, CEO and Managing Director at Mahindra and Mahindra. Anish, great to have you with us here. Thank you very much. you know, I dare say you're one of the most loved CEOs, especially from an investor perspective, Anish. I was looking at returns. Since you took over, stocks up 4 times. You know, we can say markets have done well, but that is still astonishing for a company that size and what the stock has done. So congratulations. And congratulations on a superb set of results once again. I want to start with the tractor business because volumes in the June quarter were flat. They were down earlier. They were flat. You're guiding for a 5% growth for the full year FY25. Monsoon rains are good. I mean, they've gotten better. Could we be at the end of a down cycle, beginning of an up cycle? Your thoughts?
So Prashant, first, thank you for the kind words. We've done a lot of great work as a team. So I would say all the credit goes to our teams. And we've got a very strong operating rhythm. On tractors in particular, we are seeing green shoots. Clearly helped by the monsoons, but beyond that, government spending is up in rural areas. And therefore, we do believe that we should be out of the down cycle now. The second half should be fairly good as well. Navratri comes in at that point. So we are in a much better place from a tractor standpoint.
And if the down cycle is ending and an up cycle is starting, as some are pointing out, could it last? I mean, someone was saying that the up cycle usually lasts 3-4 years. I mean, it's not 1 quarter, 2 quarters, but once it starts, it continues the momentum. Is that a fair assessment?
That is what we have typically seen. So that's something we would look at as a fair assessment based on history.
Would you like to raise that guidance for 25 a little bit, just a tad bit for right now?
At this point, we feel 5% is a fair guidance.
With upside risk?
As I said yesterday in a press call, taking cues from the Fed governor and the RBI governor, we'd say there's an arrow that's pointing towards the up, but we are at 5% for now.
But at least, we're past the worst when it comes to tractors, overall industry and for M&M, and the growth is going to sort of sustain and continue?
For M&M, we've seen growth very substantially, even in a flat market. A tractor market share in the first quarter was up 180 basis points, which when you're in the 40s is a fairly tough thing to achieve. So not just tractor, LCV was up 160 basis points, SCV up 130 basis points. So from an operating standpoint, we've been fairly strong.
No, absolutely. And now I want to come to the cool business, which is bread and butter and SUV. Your leadership, your dominance continues, and I think the market share has only increased even in the quarter gone by. I just want to quote a figure from one of the analysts on the street, Jeffries. Now their projections are they're expecting your auto volumes to show sustained 14 to 15% CAGR over the next 2 to 3 years. I mean, going up to FY27 with dominance. You think these are fair estimates, or do you think you're going to surpass them by a mile?
So the guidance we've given for this year is mid to high teens growth. And the first quarter was 24% growth. So you can extrapolate based on that.
So 15% CAGR next 3 years, auto business?
It seems reasonable in a sense based on the trajectory we have right now and the demand that we've seen for the models right now.
Okay, all right. Hi, Dr. Shah, and thanks a lot for coming down. Besides the shareholders, I was speaking to some of your employees as well. They as well seem quite pleased, so that's good news, I think, so when the home is happy. But let's talk a little bit more about SUV. As you said, y'all have been growing quite well. I think the market share as well has been moving up. What's the rough market share that you're headed to, say in FY25 and then FY26? Because you have been guiding that you're going to outgrow the industry.
I think it depends a lot on how the industry will move. The auto industry has been relatively benign and flat for a while. Not exactly flat, but still growing at a slow pace. With India growing the way it is right now, there is a potential for an uptick there at some point in time.
Right.
Now, when is that going to happen? Your guess is as good as mine on that. So, which is what we'd have to wait and watch in terms of where we go.
All right, but SUV, I think you were at around 15%. It's moved to around 18% as of last reckoning, right?
Yes, from a revenue standpoint, which is what we look at, we are at 22% now from a revenue market share perspective.
Okay, all right. And also, if I have to focus on your margin picture, there were some price cuts that I think you took in the XUV 700 segment. But you have been changing your mix. Some part of that mix will be margin accretive as well. So from here on, will margins improve as a consolidated entity?
So we've seen a significant jump in margins in this quarter. And yes, that is a question we've been getting from a lot of our analysts as well. We are putting a lot of effort in to enhance margins. There will be positive and negative pressures to that. So for now, we're essentially saying that we will continue to maintain where we are. We will continue to see some improvements over time. But we also use that in a way to manage both growth and margins. And which is where we decided to have a price cut, because we had increased prices significantly over the last 3 years as a function of commodity price increase, as a function of concerns and issues with semiconductors. As that has eased, it was important for us to pass that benefit back to consumers as well and drive growth. So that is a combination that we will continue to look at, and which is where it's a management of both margins and growth.
You know, on just to continue with the SUV side, for the last couple of years, we've all focused and fixated on the bookings. But the bookings number has come off a little bit. But I think that is also because waiting periods are now lower. I mean, is that the way to look at it?
Yeah, so the main thing that we have is capacity, right? We've gone from 19,000 SUVs a month to 49,000 today. And at the end of this year, we will be even higher than that. So we've, at this point, got almost a 3x increase in the last 4 years. Capacity was difficult for us to put in 2 years ago because of the semiconductor issue. We actually didn't like having a long booking pipeline. It's not good for the consumer. And the cost of putting capacity is not that high in the overall scheme of things. So for us, our goal is to try and keep that booking number down as much as possible. Not new bookings, but the backlog. And therefore be able to give consumers a car as quickly as possible. So that's the reason why, yesterday we stated that, look, that's the last time we'll talk about the backlog, because we are starting to get to a point where with increased capacity, we can start meeting that backlog very well.
And capacity is going to be good for, of course, depends on growth and underlying market dynamics, but your sense?
We still plan to increase from here. We have talked about going to 64,000 from here. So that's something that we will continue to do, because with the FIDO Thar coming in, we will need more capacity as well. And that's part of what will come in.
In terms of the powertrain or just the vehicle itself, right? There's ICE, there's electric, and there are a lot of electric launches happening. I know you've been quoted in the media, on hybrids. But what's the thought process? And from the company standpoint, both volume and profitability, how do you think this will play out? Because let's face it, I mean, electric vehicles are more expensive than ICE. So as those launches kick in, do you think that there could be a bit of a dent in volumes just because of the pricing element there? And I don't know, I mean, hybrids if they even make sense. There are some states offering incentives on it. So just in terms of technology, what are we looking at over the next 2 years in terms of the product mix, how you forecast the market?
So let's look at why EV is important. If you think about it from a government or a policy standpoint, EVs solve two major problems. One is pollution in our cities, and second is a fuel import bill. So both of these are not really addressed by hybrids as much, and which is why governments around the world have found it very difficult to provide incentives for hybrids for the last 20 years. Hybrid, again, is a powertrain. It is more expensive than ICE. The question is, are incentives required there forever if we have to move there? For EV, that's the other advantage. You may not need incentives forever. And if you take the example of electric three-wheelers, the FAME 2 program was very well designed, and that created a stimulus for electric three-wheelers that has gotten to 20% penetration as an industry. And that will go to 100% in the next 5 or 6 years. So that is essentially a very successful use of incentives, because in that time frame, by 2030, we will not need any more incentives for electric three-wheelers.
What about four-wheelers? What would you like the policy to be as we get more and more, EV four-wheelers in the market, your portfolio included?
For four-wheelers, we feel the government has provided all the incentives required. With the PLI scheme that's in place, with the GST program that's in place, there is nothing further required from an incentive standpoint, right? And over time, that will come down as well as four-wheelers expand. What is essential for four-wheelers is a charging ecosystem. And that is one area where we know that the government is very focused on it. They're looking at various different ways to enhance the charging ecosystem. As that happens, we will see four-wheelers start taking off, because it starts with the product. You've got to see the product and say, I love this product. And then you start thinking of charging. And if you have the charging infrastructure behind it, then it's much easier to transition to four-wheelers.
But just coming to complete this point, to come back to that question on pricing, because EVs are priced, above ICE models. How do you expect this to play out, consumer behavior, and in terms of your own targets, in terms of growth of the M&M EV portfolio, what do you forecast this year and say next year, and in the near future?
So we've got our born electric vehicles coming up starting January. And I can tell you that I'm very excited about those vehicles and I'm looking forward to driving them. Incentives have to play that role to bridge that gap in pricing. Because if the pricing is far higher than ICE, then electric is not going to take over. So we feel that incentives have done that job and that the pricing will not be dramatically higher than ICE. And that will help us transition to electric. And over time, the cost of electric will come down and incentives will come down as well.
Okay, all right. Mr. Shah, what about the new launches? I think the street is looking forward to the 5-door Thar. When does that come into the market? And also, what are the rough estimates you're looking at there in terms of demand?
So August 15th is the date for the 5-door Thar. And we are very excited about it. It has come out extremely well. And in terms of numbers, we'll just have to wait and watch. We'll have to see what consumers think of this.
By the way, Surabhi was saying, moving on to the cooler business, right, for SUVs. I was thinking tractors are cool.
Of course they are.
I've always wanted to drive one, but I've never got the opportunity.
You could be looking at it, in a very, very different manner.
Anish, I just want to step back one bit, right? And I began by saying investors and markets see you as the value creator. So when you think about what next in terms of value creation from an investor point of view, one thing, it's not new, it's been sort of, you've been asked this before, is demerger. For autos and tractors separately, because the company still gets a holding company discount. Is that on the anvil? What's the internal thinking on it?
So this is a question we've faced for a few years now, and the response has always been, first we're going to focus on inherently creating value with better products, with better execution, and that's something we've done. In many ways, there should be a benefit given to companies that are together and generate synergies. Today, we've got obviously much higher margins in farm than anyone else because we've got a higher market share. But our auto margins are very well placed in the industry, even when we may not be the number one in the industry. And that's because of the synergies we have. Purchase synergies are significant. Technology, talent, there are a number of other synergies that we have. And therefore, what we're looking at right now is, can we showcase that as an advantage for the group? And we already have certain analysts talking about a conglomerate premium in our recent analyst reports. But that is really what we think we can be able to showcase.
So should I take that as at least in the immediate future, I mean, no? I mean,
not happening.
In the immediate future, no.
Right.
But at some scale, would you like to demerge both the entities?
For us, if it makes sense economically to do that, we will.
Is there a scale in mind?
It's not a question of scale. The question is there more value for it together than apart?
Okay.
Right now, you see more value together.
At this point, we see more value for it together.
Because if you look at, say, I mean, and back in the day, Escorts, for example, used to, the valuation, it used to get a higher valuation compared to the implied valuation for the tractor business here. Maybe it's now closer, much closer. Maruti, Honda is going to be listing soon. Average P multiples of 30, 35 times. I mean, conglomerate premium, that may happen in the future, but as of now, there is that discount. So that's the reason that's the point where I'm coming from. But you're saying we're not there yet.
We're not there yet. We are seeing that discount reduce. As I said, we've seen the first analyst report that talked about the conglomerate premium just 3 months ago. And it's coming from the fact that we're starting to show greater value in our businesses. So to me, that's a fundamental question. How can you create greater value? Is it by being together and having intrinsic value that's greater, or being separate? And if the answer is being separate, we'll look at it. But today, we don't believe that's the case.
Okay, so Anish, we've spent a lot of time speaking about auto. Allow me, as we wind up, to request you to wear your other hat as the head of Tech Mahindra as well. The reason we're bringing this up is, I know it's an issue specific to a different entity and company right now. I'm sure you've seen the headlines. Tax demand notice, a rather big sort of notice that's gone to Infosys in terms of how overseas branches need to be treated from a tax perspective. Just as you see, you've already laid out a roadmap for Tech Mahindra in terms of improving margins. Just leave us with an overview. I think the margins as of this quarter were 8.5%. How you see that trajectory play out? And indeed, if such notices start going out to some of the marquee companies, is it any reason for worry from a sector standpoint, from a tech industry standpoint?
So, two parts to that question. First, we see Tech Mahindra on a good path of recovery. This is a business where we've talked about a 3-year turnaround plan. We've outlined the plan as well. Similar in many ways to the plan we'd outlined for Mahindra Finance a year and a half ago. And Mahindra Finance is on a very good track. Now we've seen fantastic results this quarter, better asset quality, strong growth, a lot of work on the technology side. So therefore, TechM will continue well on this path. Phase 1 is to get back to the margins that we were at, which is a fairly short time frame. And then the phase 2 is to look at 500 basis point margin expansion beyond that, which again has been outlined in the plan. So we feel good about where Tech Mahindra is with the new team, with the delivery mechanism that we've put out there. And the second part to your question, look, we feel that the government has always done the right thing in terms of making it easy to do business with. So I'm sure that that is something that will end up in the right place. I don't know the details of the facts, so I can't say anything more at this point.
Got it. Anish, pleasure speaking with you. Thank you very much for taking out the time and being with us here in the studios.
Yes, in person. That really counts.
And I hope we can do this more often here. So much better. Thank you very much.
Sounds good. Thanks for having me here today.
Thank you. All right, well, that is Bossman at Mahindra and Mahindra with perspective on a variety of businesses and, of course, an overview of what the next many years may look like. Well, the market's up about 85 points. We're 25,000 plus still, so holding. We're going to take a very quick commercial break here. We'll come back and we'll have the management of Birlasoft join us on the other side to discuss their first quarter earnings. Stay tuned.
Welcome back. Let's turn our attention to the tech space. And a mid-cap company, Birlasoft, reported a disappointing set of numbers. Growth got clobbered back. But let's find out what's the way ahead from here on. We have Mr. Guha, the MD and CEO of Birlasoft, who joins us on the show. Hi, Mr. Guha. Good morning, and thanks a lot for joining in. Always good to have you on the show. Well, the past quarter was a bit of a dampener for a whole host of issues. There were deferrals. There appears some softness in discretionary spending as well. You tell us, how are things likely to shape up? And I want two numbers from you. Earlier, you were guiding for industry-leading growth, or maybe you'll outbeat the industry growth as well. Do you stick to that? Last year, I think the top line grew by close to 7%. So for this year, what's in store with this, softest start to the year? And also margins, you were guiding, I think, for around 16% on an exit basis. Are you headed in that direction?
So, Nigel, first of all, thank you for having me on the show. So, look, we admit that the first quarter was not really a great quarter for us. I mean, it was disappointing. Even for us, it was disappointing. But, Nigel, you must also realize that this is on the back of almost 5 quarters of constant sequential and year-on-year growth. So we disappointed the market this quarter, but I think we will come back strong in Q2. From a margin perspective, again, because we did not deliver top-line growth, and as you know, our business is so heavy on operating leverage, the margin suffered a little bit. But I feel if the revenue growth comes back in Q2, which I think it will, you will see an improved margin.
Okay, so what are the numbers you want to give us then? Margins, a little south of 15%. Revenue, you're expecting things to grow. I'm guessing that the macro hasn't got worse for you. So growth for this year, do you stick to that industry-leading growth? And margins will see an improvement of how much? 150 basis points from year. Previous quarter, you were at 16%. So you get back to that mark?
So, Nigel, we can't give a guidance, and we don't give a guidance. Our job is to execute for the quarter. So I can't really talk for the year. But for the quarter, I can tell you Q2 will be better than Q1. That we are very confident about. As far as margins are concerned, we will see how Q2 pans out from a margin standpoint. For the year, it is difficult to give a guidance only because the Q1 was a little disappointing for us. So we will take one quarter at a time and see how the year pans out.
Mr. Guha, would you characterize the demand environment as still very, very tough?
So, Prashant, the demand environment has not really changed from the last time we spoke. I feel the demand environment is tough, but it is little cautiously optimistic from a standpoint that it probably is getting a little better. We're seeing some green shoots to begin with. But again, there are elections in the US, so we will see how that pans out. But by and large, I'm seeing demand not very different from what we saw in 4Q.
Okay, all right. And what about the total contract value? That as well did see a sharp fall. Any order closing got delayed, which explains the reason for that decline?
So, Nigel, if you look at from a year-on-year perspective, our order booking has actually gone up. We grew 10% year-on-year on order booking. Now, Q4 generally is a strong quarter because we get a lot of renewals. So quarter-on-quarter may not be the right way of looking at it. My sense is, from an order booking perspective for the year, this year will be better than last year.
Okay, this year will be better than last year. Could you talk to us a little bit about how the Microsoft business is likely to ramp up? What's the outlook there?
So that business is growing, Prashant. So we partner with Microsoft very significantly, as you know. They're a big partner. I can't give you specific numbers because we can't talk specific clients, but that is growing above the company average for sure.
Okay. Over 20% on a year-on-year basis?
Again, can't give a number, Prashant, but I can only tell you that far above the company average, double-digit growth for sure.
Okay, far above the company average, double-digit growth. Thank you very much, Mr. Guha. Thank you for joining us and running us through the numbers as you see them. No real sort of guidance in terms of numerical numbers, but in a tough demand environment, which has not changed from the last quarter, they're saying that they're cautiously optimistic. We'll take a quick commercial break here. Prestige Estates Management joins us on the other side to talk about their numbers. Stay tuned.
Welcome back. Prestige Estates is the next company on our radar. For the first quarter, the company saw a decline in pre-sales and sales volume, with which collections also saw a single-digit growth. We have Mr. Irfan Razak, Chairman and MD of Prestige Group, to take us through not just the Q1 performance, but of course the outlook going forward. Mr. Razak, great to be speaking with you as always. Now, looking at the slightly quieter start to the year, how does the rest of it look? Because we're almost, virtually practically done with the second quarter, at least 2/3 of it down. So what's the visibility on sales for overall FY25?
Good morning, Nigel. Yes, quarter one was subdued only because there were not many launches, because the approvals couldn't come on time, and that's consequent all the elections and the code of conduct that was on. But we are quite hopeful because we've got a large launch pipeline, and Q2, Q3, Q4 should do extremely well as we go along.
Sir, just a small submission. I think you're missing Nigel. This is Surabhi here, but I'll tell Nigel that you were asking about him. No, okay, fair. Okay. So let's get back to it. Just give us a sense on pricing as well. First quarter, have you managed to take some price hikes, and what's the visibility? Any more, price elasticity in the market?
Pricing, I believe, has reached a certain number, which actually, honestly, the price is a function of the cost of land and construction, and of course, the overall margin that we as developers would like to aspire to have. And we would not like to price our products too high, which would be counterproductive. I've said this before, I'm saying this again. We have to make sure that whatever pricing that we do on our product is affordable in the circumstances that are there. And I believe that we have reached a certain point where any more price increasing will not really be good for the market. And I think even now it's pretty good in terms of, depends on which location and what type of product we are able to offer at decent numbers. And I'm sure going forward also that will be the endeavor of the company.
I got it. Mr. Razak, hi, morning. I want to just talk about the budget and what is done, right, on indexation. Do you think, because there is, of course, there's no indexation, but also tax rates are lower now from 20 to 12.5, for new real estate sales, sentiment-wise, at least for the potential buyer, it actually makes things a little more attractive for new sales. A legacy, a property, etc., that's a different matter. But what does it do for new sales? Yeah.
No, I personally believe there's a lower rate of tax, 12.5% on long term. And it takes out a whole lot of question marks, a whole lot of guesswork and trying to work out the indexing and all that. So I do believe that this is a good move. And it's very easy for anybody to calculate according to the gain that they have made. And I think it's only a question of acceptance, because a 12.5% gain long term is a pretty good deal. Okay, everybody wants more. If it was 10, it would have been better. But then I think at 12.5 also it's a good number. And I think we should accept it. And it is good for medium to long-term investors and new buyers. Of course, a very, very historical properties there'll be a marginal difference, but I always used to advise customers whenever they sold a property, even historically, I said your capital gains will be in the region to 10 to 12 or 12, 15%. Now it's at 12.5%, so I think it's pretty good.
Although I must say, we reported this yesterday, Mr. Razak, the government is reviewing representations which have been made on the indexation issue, right? There is no clarity if there will be a rollback or any changes. As they stand right now, things stand, but they are reviewing a lot of the representation, etc., which has been made. But my question was not about legacy. I mean, that's a different debate, and we go into a different realm, which we've done with tax experts, etc. But I'm asking you from a future property purchase perspective. I mean, for a potential buyer in their mind, I mean, even if they want to sell it 2 or 3 years down the line, even if they don't, the tax rate is lower now. So does that spur new sales as you see it? Your thoughts?
No, I think it'll help. You see, people are not buying today only to sell tomorrow.
Correct.
they are investing to buy a home. And
Correct.
if our investors who want to be there long term, they definitely will see that as an incentive because everybody is looking at ways and means how they can save tax and at the same time earn some money. So that's probably a trigger that people can buy some homes and then hope to sell once the product is ready. And then the gain will be 12.5%.
Okay, and that's why maybe the lack of indexation won't pinch so much. Let's see. We'll find out what investor and end user behavior is like. I think the answers will come through over the next couple of months. Mr. Razak, thank you very much for joining in. Always a pleasure speaking with you. Well, with that, we have to take a quick break. On the other side, we'll have the management of Bank of Baroda joining in to talk about their first quarter performance.
Welcome back. It's earnings time. Bank of Baroda impressed with a lower NPA and hence a much lower than expected credit cost, or what you call provisioning for bad loans. But deposits and advances growth have been soft like in all other banks. Margins are hit by higher deposit costs. Joining me now is Mr. Devdutt Chand, the Managing Director and CEO of Bank of Baroda. Mr. Chand, good morning and thank you very much for sparing time for us. Well, first up, your margins have held up the same pressure that others have felt. But do you think you are going to see a higher cost of funds because of the LCR requirements?
Good morning, Lata, and thanks for inviting me. A couple of things that went for this quarter. Clearly, we wanted to realign the balance sheet in terms of the liability management. And if you look at the growth both on the advances and deposit, these are in line with the market, but we could have grown a couple of percentage higher. But we wanted to reduce the dependency on the bulk deposit.
Yes.
If you look at the cost pressure, in fact, the cost of deposit was increasing almost like 10, 11 BPS quarter to quarter. And if you look at the June quarter vis-a-vis March, it is the flat level. So we have a better control on the cost of deposit now, and the outcome is that the margin is maintained. We had a full year NIM of 3.18, and this quarter again the same 3.18 we have. So I think we're in a much better position in terms of looking into giving a stronger growth from the next quarter onwards. Because not only on the margin side we have hold on to the margin, at the same time the dependency on the bulk we have reduced significantly. Third, slightly the fine price asset, which are high quality of course, we have reduced that. And on the capital front also significant jump in the capital also.
Oh, capital. Yes, I'll just come to the capital in a minute. Just on cost of funds, do you have more elbow room to reduce bulk deposits? And secondly, what is the extent to which you have to increase deposits at all? Because I think you are sitting in a comfortable LCR. It's what, 130 or something, right? So
we are at 138, yeah.
Okay, so will you just bring it down to what, 120 and be happy about it?
Yeah, absolutely. They are all management of multiple factors they are in. The moment you look into LCR 138, even if the draft guidelines comes into finality, the impact would be something around 12 to 15% maximum. So we'll be at a comfortable level. The same time, as far as bulk is concerned, if you look at as far as we are concerned, FY23 over FY22, the percentage of bulk as a percentage of total deposit went up by almost 600 BPS. And now in June 24 also, we are almost at the same level as far as the percentage deposit concerned. So in the process, we have made the deposit profile much more stable at the same point of time, keeping the margin also intact. So from here onwards, I can think that I can play around with that margin because the margin guidance we are giving 3.15 plus minus 5 BPS. So depending upon the outlook on the loan side in terms of their pricing, I think we can still increase the bulk, but obviously keeping the margin factor into mind while increasing the advance.
3.15 is for the full year, I would assume.
This is for the full year, plus we have given a guidance of plus minus 5 BPS. That is what we have been telling for multiple quarters now.
Okay, but more generally, cost of funds will go up, you think, because there is a war for deposits?
There are two scenarios panning out. Actually, the cost of deposit not only depend on the rate stance, but also the available liquidity in the market. And what we are seeing for a couple of weeks now, that it's now getting better than the earlier. So my sense is that even if on the rate stance, things may continue as it is, but because of a better availability of liquidity, possibly cost can moderate. But that may not happen immediately, but slightly I may looking at Q3, maybe the cost of deposit would moderate. So in that scenario, it would give further leeway for us to increase on the advances side.
Okay, and not all banks are agreeing. HDFC Bank just raised its deposit rate on several tenors. So many of the banks told us that the pressure continues at least this quarter. Let's see if the government, the RBI cuts CRR or something. Okay, let me come to the slippages part. Your retail loans did show some slippages. I think 1.7%. How is it shaping up? Can it get worse in the current quarter?
No, I don't think so. Reason being because we map out the SMA book on the retail and also the collection efficiency. Both are at this point of time quite strong. So I don't think this retail slippage is some kind of a seasonal one-off kind of a year. And if you compare The slippage ratio vis-a-vis the Q1 of the last year, it is much better. And the credit data also showing much, in terms of the Q1 of the last year and Q1 of this year. So I don't think that going to continue. It's something one of seasonal, and I think will be like, because we look into these accounts more closely, I think a lot of pullback could happen out of the slippage that happened for this quarter in the Q2. So things are fairly stable in terms of the asset quality.
Okay. Yeah, of course, you'll have done extremely well on recovery and upgrades. And I must admit that a lot of other banks' annualized slippages are higher than yours. Mr. Chand, now to come to the other two small, minor overhangs on the banking system. If the project finance provisioning rules come, how much can your provisioning go up?
See, last time also the same, because it's a draft guidelines as a policy, we normally, because unless and until the final guidelines comes, we can't actually take a call on that. But considering my scenario, see, a couple of scenarios, let me tell you very clearly. One is that my capital adequacy is very strong, and that is out of internal accrual. The second is the margin is also fairly good considering the market, in terms of the market scenario. And thirdly, in terms of my dependency on the bulk on the cost side, not only on the interest cost, but we have also a strong lead on the operating expenses that would have seen. So as against a 25% growth earlier, now the growth is only 14%, 14.5%. So scenario like that, any impact because of the project finance, consequently, I give you a scenario like when the risk weight of the NBFC and this personal loan came, the impact was almost 68 BPS on the CRAR. But currently, if you look at the CRAR is much better because the banks normally do pass on the impact therein. So I think any guidelines coming on the matter on the project finance, I think the bank's balance sheet is well capable of handling that, or that may be a scenario where we can pass on to the customer to recover the impact there.
Okay. You have taken board permission for 7,500 crore of additional capital, right? Are you likely to do that very quickly? Market is at 25,000. It is in the best of spirits. So should we expect, and will it be an offer to the public, or will it be privately placed?
No, it will be privately placed. That is one. Secondly, if you look at my CRAR, there is no urgency for me to raise this capital. That is very clear. And sometimes, particularly long-term capital bond, it also depends upon the market appetite. At the same time, the rate stance. So our own house view with regard to the rate stance is that possibly expecting a Fed cut maybe in the month of September, and consequently a bit of moderation happening on the rate stance. That is what our expectation is. So we'll be timing it in a manner where we get an optimum, interest cost in the issuance side. So it's not immediate, but there would be maybe this quarter or next quarter possibly will be hitting the market.
Okay. Well, finally, if you can give us some idea of where growth will come from, what kind of growth in advances are you penciling in, and from which verticals?
See, if you look at the current year retail, we are doing, the growth has been more than 20% for last many quarters now, and this quarter also the retail is more than 20%. And if you, compare the Q1 of the last year and Q1 of this year, the change in retail is almost 250 BPS. Towards positive. That means we have increased the retail book. And typically in the bank, we talk about retailizing the book, and slightly that is what it has worked. MSME and Agri this quarter slightly below 10%, but there we would like to grow slightly higher. We are targeting something around 14-15% growth in MSME and Agri. Particularly the budget is giving a lot of support for the MSME. I think that would be an achievable one. Corporate side, we have strong pipelines. And as I said, corporate, it's a how do you balance the portfolio? That is important. There are strong demand from the renewable side, on the infra side, even on the cement and some other core side also. So the pipelines are quite strong as on today, as far as we are concerned. And I think on the corporate side, we are giving a guidance of 10 to 12% growth for the full year. And I think we'll be in a position to achieve. So the overall loan guidance for the full year is around 12 to 14%. And I think currently, based on the pipeline, our capacity to grow because of a strong CRAR, good margin, I think those are things which can be achieved by the bank for the full year.
Okay, your full year credit cost guidance was?
See, this time the best part of the credit cost is below 0.5, but earlier we had given a guidance that we'll maintain credit cost less than 1. Keeping everything, the ECL framework, everything in mind. But this time we have again revised it to less than 0.75. And as far as Q1 is concerned, we're at 0.47. So in that way, fairly balanced and well positioned therein.
Okay, below 0.75. That's, well, let's hope it's 0.5. Thank you very much, Mr. Chand, for joining us with all those details. So Bank of Baroda promising good growth and, of course, lower credit cost, which is what the street wants to hear. Wrap up on Bazaar on that note, with the market still cheering 25,000. Chartbusters will take the action for.